The fast food giant McDonald's is permanently closing 200 stores and saw their earnings crater last quarter. Is the stock now in bubble territory? Let me tell you, coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Welcome to this channel. If you are new, hit that subscribe button, turn on notifications, and smash that thumbs up button. Okay, all sorts of confusion with valuations and the market being so unbelievably expensive that we've really got to get out of this coronavirus recession as quickly as possible to justify these prices, or we just need another injection of stimulus, which may be coming, by the way. But no one's talking about a McDonald's stock bubble. Let me tell you something. What if I said, hey, would you like to buy my business? And my business happens to be a restaurant, and restaurants, as you know, restaurants, retail, some of the hardest hit industries going through this pandemic. And so, hey, do you want to buy my restaurant? And you say, well, gosh, I don't know, might not be a good time for that. Restaurants seem a little risky with shutdowns and all this stuff. How much is it? And I give you a number, and you say, well, okay, well, how long will it take if I buy your restaurant for that much? How long will it take for me to actually get my money back and start making a profit? 25 years. 25 years. If you buy my restaurant right now, you'll slowly make enough money that over 25 years you'll have broken even. And then, hey, good news is from year 26 and beyond, you're in the money. You're in the money. Would you take that deal? Would you buy my restaurant for that much? No, you would have to be insane to do that. Guys, that's the example of the price to earnings ratio, and that's the price to earnings ratio of McDonald's before they announced their earnings yesterday that absolutely cratered. Their revenue is down 60%. Revenue, not profits, because they've said, listen, we're permanently closing 200 stores out of 14,000, and we've had 10,000 stores that we have had to make some sort of adjustment with but we're going to be fine. We know how to handle this now. And they've said that revenue decline, this earnings per share decline, that dropped to 65 cents a share, which doesn't really mean anything except when you compare it to the $2 a share that it was last year. Well, they've said all of that drop was because of the closures. We've had to close the dining room, so drive-through is the only thing that's open. But guys, they've also said with this second spike of cases, they're looking at and needing to start closing some dining rooms again. And yet the stock from a price to earnings ratio is right back up to where it was a few months ago. The stock is right back up to where it was. Guys, this earnings per share, that example where I said, well, you buy my restaurant today, after 25 years, you'll break even on that investment and you'll start making money after that. Guys, that doesn't even account for yesterday's report of their earnings dropping ridiculously. I actually can't even find a new chart. I wanted to show you, find a chart showing what their new price to earnings ratio is going to be. It's going to skyrocket. And yet the price is just fine. And no one's talking about the McDonald's stock bubble. Because McDonald's is a great stock. It's the restaurant food chain we all love to hate, right? I don't like McDonald's, but in the right mood, after a full day at the ballpark with the family and no plan for lunch, we're running through McDonald's, right? And so, but the stock has been great. The issue is it has absolutely skyrocketed over the last 5 years, and the coronavirus risk has barely even made a dent in the stock price. And now the price that you're having to pay for the earnings is an outrageous price, especially considering the risk. Why am I telling you this? There's a ton of examples just like this with McDonald's, tons of them. You need to be cautious and disciplined with your overall investment approach. I met with someone yesterday who's got all of their money in CDs. They've moved it all into CDs, and I would be careful about that approach because the trade-off there is I take my money and I'm no longer earning anything with it. Well, if I have financial goals and I need that money to grow for me, that approach doesn't work. You might say, well, yeah, but at least I'm not losing. I can't grow my way to my financial goal if my investments go down. I get that. I do get that. But the risk, the short-term risk of having them go down is the trade-off for the long-term confidence that it'll be able to grow. The point is you need to have a diversified investment strategy. You can't have all your investments in McDonald's. You can't have all your investment in GE or GM or Ford or Tesla. That's right. You can't have all your investment in Tesla. You need to be diversified, spreading that around so that if McDonald's actually does turn out to be a bubble and that goes down, hopefully you've got, Pfizer or something else that picks it back up. So you need to be diversified, but then also the market is too high, so high right now, it's risky enough that you need to have multiple investment strategies. We've got our disciplined approach of index funds. We complement that with a momentum strategy that has been completely in growth investments, pivoted completely out of the market when there was no momentum at all, pivoted back into growth investments, and we're very cautious on growth investments. It seems like they've run up too high too quickly, but we're riding that momentum and it will pivot when the momentum changes. That's the approach that you need in your financial life with your investments, and that investment structure all needs to be connected with your overall financial plan to make sure you're taking the right level of risk. So there we go. We'll see. Only time will tell whether McDonald's is in a bubble or all of the stock market's in a bubble, or if I'm just speaking nonsense and we're going to get through this coronavirus pandemic recession, no problem, and everything's going to level itself out. Only time will tell. Work with your CFP to make sure you've got the right investment approach that connects with your overall financial plan. Need a CFP, need to talk to one, need a second opinion, you can always contact our team of certified financial planners right here at Korhorn Financial Group. Find us online, wisemoneyshow.com or korhorn.com, that's Korhorn with a K, or you can send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.